But I want to talk to you about something called equity risk premium. And stay with me here. It's ERP. That's the return investors expect to make over the risk-free rate, the 10-year. So if you look back at history, stocks usually generate 8% return annually, right? That's historically. With the yield on the 10-year averaging less than 2% since 2010, it translates into people should expect returns of 6%. I don't know what they are. I know the last 3 years were fantastic. Before this year, much, much higher than 6%. Can't go back to 2011. I know the market has done very, very well, but on average, that's what you would expect, right? So what this gauge does is you want to make sure you're getting compensated for the amount of risk you're taking, which is all about investing. That's what we do here, the risk reward. I mean, you don't want to risk 30% to gain 15%, right? You want to risk 30%. Sometimes a lot stops at 35% because I expect these stocks to more than double over 18, 24-month period, maybe a little bit longer. So every investment should always be about risk reward. Should I do this? Now, that's what equity risk premium is. You look at past crashes, the Fed I want to say 100% of the time. I think it's 100% of the time. But the Fed almost always lowers rates. This leads to a higher ERP, equity risk premium, for investors, which is good for equities because they're like, okay, the market's coming down, rates coming down. Now, with that 8% return, I feel like I could generate more of a return because stocks have just fallen 20%, interest rates are lower. However, during this crash, the Fed is still tightening, which is unprecedented. They've never done when the market is down this much. Continue to tighten and say we're going to tighten over the next 3 to 6 months, which is insane. Usually it's the reverse. So what does it mean? It means it's causing the 10-year to rise. And this is the risk-free. You can go to the 2-year, which is about 4.4, but let's use a 10-year because that's how we usually calculate the equity risk premium. It's important that you know this because ERP is something that's going to come up a lot next year. You didn't really heard about it now. So we talked about the metaverse 2 years ago. Now it's every place. I'm telling you, ERP, it's going to be something that they mention a lot because this is why it's a big deal. Because when you look at stocks, it's all about risk reward. So now, since the Fed is still tightening, it's causing the 10-year risk-free to rise. So it's about 4% right now. But the ERP is actually going lower. So that premium is going lower. It should be going higher as stocks crash, right? Because the Fed should be lowering rates, but the rates are being kept high because they're raising them. And again, this is unprecedented. We never see this. So in short, it might sound confusing. Investors are not being rewarded for going long right now. They're risking their portfolios to generate 4% annual returns. If you take an 8% historic, by what the market goes up, minus the 10-year yield, that's 4%. So based on this metric, stocks are still 25% overvalued dating back to 1980 when you're looking at this metric. And that's what I think people need to understand because every market that we've been in for the past 12, 13 years, which is a lot of the experience you're seeing on analysts that come on, having 10 years experience in any industry is a long time. I have 30 years, but 10 years is a long time, 12 years is a long time. But during that time, these analysts have never been part of a market where interest rates are rising and the Fed wasn't there to pick you up. 2008, they picked this up. Not only did they lower rates tremendously, and same in COVID, but they injected an unprecedented amount of money into the markets. That's gone. The Fed's no longer doing that. You have to realize that. So all these comparisons dating back and say, well, the market's down 20%. It always comes back and it's good. You have to be careful about comparing it because we're in uncharted territory. But I think the ERP, it's a huge deal I feel like few are talking about. Because like I said, at the end of the day, investing is 100% about risk reward. And why risk your entire portfolio, which could be 20 to 30%, in the middle of what? Do you see China-Taiwan talks heating up again? Are we going to get involved with that? Do you think the Russia war is going to end? Inflation, core CPI, still hasn't peaked. Still hasn't peaked, right? Which tells you the Fed's going to go nuts and continue to raise rates like they said they're going to do. Do you want to risk your entire portfolio during this environment where you could just sit back and earn 4%? You say, well, inflation's 8%. Inflation's going to go lower. It's not going to be 8% next year. It's going to go lower. And it's all relative, right? I mean, you can include the inflation fixture number in if you held in cash. If you decided to buy stocks and you're down 20% plus the 8%, so it's all relative no matter what you're doing. But taking inflation out, you could generate a 4% return for risk-free, which is pretty good. I mean, people would die for that return 3, 4, 5 years ago for the last 12 years. Risk-free 4%, that's a great return. It's such a great return that 4% risk-free was kind of the return during the housing crisis when, interest rates were low and people say, hey, let's create these crazy AAA products. It's risk-free. When you create risk-free return of 4% when interest rates is zero, you get $1 trillion into you from everywhere. That's the ultimate goal. Insurance, everything, all these massive pools of money, right? So now it's 4%. Yes, everything's going higher. Interest rates are going higher. The 2 years even higher at 4.4%. But you're not getting compensated for the risk you're going to take. And this is like one of the first times you see this discrepancy because the Fed is doing something that it's never done. It's raising rates in the face of a market crash. You say, well, Frank, I want to buy the largest stocks, and a lot of them are pretty cool. That's fine. You keep a couple of them, but don't do it because of the yield. The average yield of the S&P 500 is 2%. You're getting 4% risk-free. Why risk going into a consumer staple stock or going into a REIT with the market crashing, the housing market crashing, when demand's falling off a cliff, where people are going to start, they're starting now. They're starting to cut back spending. You're going to see it during the holiday season. Why take on that risk? Something you should think about, because that's how money comes into the market. And when you look at it from a risk return or the ERP metric, an equity risk premium, we're still significantly overvalued. And those of you quoting and looking at 17 times being cheap for this market, that's based on earnings going to 240 next year, going up 7% after going up 2% this year. I don't know how that's going to happen when the reason we went from 160 to 220 is because you injected 11 trillion into this market and lowered rates to zero. Rates are going to be 4.25%. I said this earlier. And they're doing everything they can to remove this liquidity out, shrinking their balance sheet, no longer buying bonds. How do you expect earnings to even go above 200, even go above 180? We have buybacks coming. That's good. They're cutting costs dramatically, right? You're seeing it right now. They're cutting costs tremendously, these companies. They're going to do everything they can to believe me. I've seen it. In 20 years and predicting, wow, earnings are going to come down. They almost never come down because these companies can get creative, but they can get even more creative, especially with borrowing money to buy back. They can't do that stuff no more because rates are too high. At the end of the day, you want to see demand, and demand is falling like a cliff in so many industries. Not all industries, but most of them. One by one. The car industry, man. The wholesale levels, prices are coming down tremendously. I just got an oil change. I got an oil change a little while ago. Guy charged me the same price. He charged me the same price as when I went and I got an oil change about 40 days ago. That's how much we have to drive a freaking car. My wife's car going back and forth. And despite charging me the same amount, I got oil that was about $15 cheaper. Still really good. I just didn't get the best because I'm going to sell the car, right? So it's really good oil. I'm just not putting the ultimate premium in it. And I said, how come you charge me the same? He goes, well, prices are up. I said, actually, prices are up that much in 40 days? He's like, yeah, well, everything's going up. I said, no. I said, oil's not going up. I said, oil's actually down. Why are you charging me more? Well, so I know he's bullshitting me, but you're seeing this across a lot of businesses. I talked about my car and just trying to sell me everything and putting line items in there that I didn't agree to, that I didn't even know about, trying to sell me bullshit. I'm not going to have the car for 3 years. You want me to pay $1,500 to get, extra wear and tear on my tires, which might include certain things, but most things it doesn't. And that's what they're trying to do. And you're seeing more and more businesses trying to squeeze customers. And that's going to result in less. But now I'm not going to that place ever again. I'll never go to that place. There's about 5 of them on the island that I can go to get an oil change. I'll never go to that place again because I know he's bullshitting me. You should not in 40 days. You shouldn't have raised prices by 12%. Absolutely not. But you're seeing this. You're seeing companies start to squeeze, and you're going to see people cut back and demand fall off a cliff. So I don't know where these companies are going to find those earnings from. I have no idea. You say, well, if the Fed stops, all right, if they stop, we still have rates at 4.5%. Does that mean that people are going to rush to buy houses? No. Rush to buy cars all of a sudden? They're going to feel better? No. And they have to lower rates, which is going to happen to 2024. We're going to see periods like we saw this week of 2 straight days where you get, 6% huge surge in the markets. Again, we see 10-to-1 advanced decline ratio. That's not normal. It only happens during crazy markets and volatility. You don't see the whole entire market go up like that. And that's what we saw 2 days in a row. But be careful here because you're not getting paid that premium you deserve for taking on that risk, for risking your portfolio. And a lot of portfolio managers look at that. They look at that metric and say, wow, well, it might be better to go to bonds. It might be going to safety. As far as your long positions, stocks that you think that you're going to hold long in 3 years, yeah, hold some of them. I mean, you're getting a nice bump. You're going to see the market, go back and forth. You don't want to be 100% long, 100% short, and you definitely don't want to short the markets, right? If you short, you can get wrecked.